in agriculture, we sometimes focus a lot on this one, on the political change and political issues. Some people focus more on the business side, but you can see over time how fast that changed. But technology change and social change actually happens faster. It's not Twitter and YouTube, that's not old stuff. That's actually recent developments. If you look in terms of technology, yes, it might be old, but if you look in the other business changes, that's definitely something new. Just look at, and this is also a bit outdated, I think, job titles that didn't exist 5 years ago. You will find it, and just for interesting sake, a product blogger, an app developer, social media manager, energy manager. Obviously, as a vet or as a nutritionist, that's all jobs. You won't find it on here. But look at social media influencers. That's become a job. People make money from that, and they actually make good money from it. So the changes is happening. So why is it important to have a basic understanding of financial things? Yes, it's easy to start something, but to run something, that's another part. Most businesses, they say, most businesses fail in the first 2 years that's been established. So it's important to know that financial stuff. Everything in the end that a farmer do, is linked to a financial activity. If a farmer doesn't make money, he won't farm. Farming is also a business. And all financial results is used in performance analysis, whether it's on farm, whether it's off farm, where people look at it. And obviously for us as financial service providers, we also look at those financial results in terms of lending to the agricultural sector. So there, just a indication. In the end, it's all about this one, the net margin, that bottom line. How much money have you made? And all of that on this graph is linked to that. And you'll definitely, from a vet perspective, you'll find here that there's a lot of things that you are involved in, apart from the direct costs. That has an effect on that net margin. If you look at your herd life, your calf value, obviously your calving index, that's things that you have to assist the farmer with if he's not able to do that. Obviously the market, yes, price and quantity of milk is important, but that's not the only thing that's important. And then overheads will come to that. So the basic terms, you have to have understanding about the basics, the key financial ratios, which we will cover now, and some financial statements, and obviously where you as a vet student or as a nutritionist or as a industry expert will fit in. So look at some basic terms. Obviously your capital, fixed and current assets is important. Capital assets, obviously, those things, and that's normally your fixed ones as well. Buildings, your farm, or all fixed structures. And then obviously current assets, your vehicles, cows will be a current asset for a farmer. Equity, that's what we call the skin that you put into the game. How much money are you willing to put into the game when you finance your production unit? Whether it's your own money or whether you lend it from a family member, but that's your own contribution. That's normally your equity. Liabilities speaks for itself. That's the loans that you take out. That's everything that you own to everybody, whether it's your West Bank facilities on your vehicles, or so forth. Gross value of production, that's normally price times output. That's the top line. And then obviously from that you will deduct your cost, your variable costs. And variable cost is those costs that will fluctuate as your production fluctuate. If you produce more, your variable cost will increase, and vice versa. Obviously, fixed costs also need to be subtracted, and that's fixed costs. That's normally your head office or your office costs, telephones and rent and those type of stuff. Salaries normally also a fixed one, where wages will more be a variable cost. And then you get to net farm income, your bottom line, which is the important one. In the costs, and you will find that when you are in practice, or when you do some work in the financial things, you'll find depreciation. And depreciation is a cost, but it's not a cash. It's not a cash cost. It's in general language your reduction in your market value of an asset. When you buy a new bakkie or a new vehicle and you drive it out of the dealer's door, there's already a reduction in the market value of that. You can't sell it for the $500,000 that you already paid for it just now. So that's your depreciation. In accounting terms, we use the depreciation to estimate the useful life of an asset. In terms of buildings, that's normally 10 years. In terms of equipment, and that depends on what equipment it might be, it will be less, 5 years. Vehicles, we normally use 3 years. And if you look at computers and those things, it's less than 2 years. As I've said, different values. So when you do depreciation, you take the net book value over time. So there's a couple of methods that you can use. The straight line method. Let's say you put up a milking parlor. The useful life you set as 10 years for R1 million. Just taking numbers to make it easy. Then you depreciate it with R100,000 over the 10 years. Then you've got an accelerated one, and that's where, for example, SARS allow you to depreciate the value of a vehicle over 3 years. Normally in agriculture, we do that over a 3-year period for vehicles. So the first year you depreciate by 50%, the second year by 30%, and then the remaining 20% in year 3, to get in the end to a net book value of 0. Just to note that your net book value is not equal to your market value. Although that Land Cruiser might be 0 value in your book, the market value might still be 300,000 rand. So just to take note of the difference between that. It's not a cash that's leaving a business. Yes, it's a cost, but it's not a cash that's leaving the business. So important when you look at financial statements, for example, we calculate the depreciation back into your cash, into your interest income statements, to get to a more realistic value of your costs. Some basic ratios, and Bert has referred to the milk price and feed price ratio. So obviously in finance, we also work with ratios. The first one is your debt to asset ratio. So how many debt do you have in relation to the assets that you have? And normally in agriculture, we say anything less than 40% is a healthy situation. Yes, there is some industries where we go to 80%. And that's your more export-orientated industries like avos and blueberries and macadamias. We say okay, 80% will be healthy in that situation. In terms of livestock and livestock orientated, we say anything less than 40% is healthy. In terms of liquidity, that's how liquid your business is. The current ratio, which is your current assets over your current liabilities. So your current assets is anything that you can sell quickly, and current liabilities is short-term debt. We say that a ratio of 2 to 1 is healthy in that scenario. In terms of profitability, that's also a very industry related one, but we work it out as your total capital. So that's all capital that you put in, whether it's own contribution or money that you've borrowed. We use the net farm income and you divide it by the average total capital. And anything more than 10% is good. Normally in agriculture and specifically with livestock industries, we find that 8% is actually already a good profitability percentage, especially in the extensive ones. If you look at intensive industries like dairy or piggeries or broilers, more than 10% is definitely what we aim for. There I've said it. Normally livestock is 8%. So we have a couple of key financial statements which we will look at. Your balance sheet, that's the statement of your financial position at a specific day. It's a snapshot of your assets, liabilities and creditors on a specific day, and normally at year end or the beginning of the year, doesn't matter which way you're looking at. But in farming, it's normally, from the first financial year is normally from the 1st of March to the 28th of February, to fall in with the same time that income or income tax year goes. But it may differ between businesses as well. So that's a source of information for us as a credit provider, but also for other people that use that balance sheet in terms of your short and long-term debts. How many production loans do you have and how many long-term loans do you have? And I'll come back to that a bit later. Your gearing. So your gearing is just that's your debt to asset ratio. It's just another name for that. Your reserves, how much money have you made last year that you've put back into your reserve for future use. Capital assets, and then your cash on hand. In agriculture, cash on hand is not a general thing because we use or we used to seasonal production systems. And then obviously your return on investment and your return on equity that we get information from your balance sheet. Your income statement, that's your profit and loss account. A statement of all your income and expenses over a financial period. It indicates for us your fixed and variable costs, and we always divide it also in those two parts to get an indication of which is variables and which are fixed costs. Obviously, it includes your non-cash transactions like depreciation, which I alluded to before. But not all expenses is included in the income statement. If you look at capital expenses, let's say you're a avo farmer and you've put up nets to protect your avo orchard, that will be a capital expense and that will be included in your balance sheet. And then it gives the EBITDA. Now, EBITDA is the acronym for earnings before interest, tax, depreciation, and amortization. And that's an important one for any financial institution. We talk about sustainable EBITDA, which is the number or the profit that you make to be sustainable over a period of time. So it's a measurement of your operational performance. So when your balance sheet and your income statement balance, that's normally the look that you get. You can ask any CA, they will be very happy about that. If you look at your cash flow statement, and that's the more important one, specifically for us as financial service providers, but I think for any business as well. It differs from your income statement because you will only include cash transactions. You will know at the end of the month what's available in terms of your cash or money available, whether you can pay your wages and salaries and so on. So cash versus profit, as I've said, what's available against what's the profit that you've made. The business plans and budgets. This will be the policy documents for any business. The policy that says in the business plan specific that says how the business will operate for the future, and it needs to be constantly reviewed. It needs to be live documents. You can't set it at the beginning when you start the business and you put it in your second drawer of your working station and you forget about it. It needs to be a live document. You need to review it constantly, because from that you can set benchmarks, and benchmarks is becoming more and more important in the agriculture industry to compare yourself with your peers. Obviously, when you do this, you need to make assumptions, but it's important to test those assumptions against objective criteria and objective people. You will not know everything from the outset, so those assumptions must be tested. When we look at a cash flow budget, and that's probably the most important one, especially when you apply for finance, we will do a cash flow forecast, which will need to be signed off by the client. But that's where we based our affordability for extending finance to a farmer, for example. And I will get back to that now. When you do your cash flow budget, please apply the SMART concept, where you need to be specific. You need to set parameters that's measurable, because if you can't measure it, you can't manage it. It should be achievable. It's easy to say that I want to make R1 million profit in the first year, but I only milk 200 cows or 20 cows, for example, because then it will not be achievable. It should be realistic, and you need to set a time frame to that, because if you don't put a time frame to it, we are very good at procrastinating. So times is very important. So if you look at lenders' requirements in terms of financial statements, you need to provide evidence of affordability. With the National Credit Act in play, that's very important. Affordability will be one of the first things that we look at. Cash flow, as I've said, that's the most important one. Ownership, obviously very important, because the bank will not extend credit to a value that's greater than what you own in the business. Normally, we have a 60% LTV, a loan to value. So when you borrow money and you put a farm up as security, you will only get 60% of that farm value as a loan. The rest must be either through own contributions or security from other sources, for example. Sufficient assets to offer as security, whether it's a farm, we can also use shares and other other assets as security. But nowadays, becoming more and more important is to bank the jockey. You as a farmer or as a business owner, whether you're in a veterinarian practice or in some kind of other practice, you have to show that you have sufficient knowledge of your area, the skill and experience to manage the business, to achieve those financial results that you've indicated in your business plan and cash flow statement. So banking the jockey is becoming more and more important. And then when you're not having those skills, your willingness to accept expert input is also important. So credit to match the purpose, and I've alluded to that earlier. Different kind of loans, long-term loans, normally up to 15 years. The land bank used to have a 20-year loan as well, but that's not a general type of loan nowadays. It's normally 15 years, and that you use to buy land and to put up fixed improvements, buildings, pack houses, milking parlors, and so on. Then you've got your project or your medium-term loans. That's normally a 5 to 10-year period, and that you use to expand your production capacity, or for livestock purchases. For livestock purchases, we normally look at 7 years, and not to 10 years. And then your seasonal production credit or your short-term loans, and that you use, apologies, to finance your production expenses, those annual expenses that you have to do. And that we normally do via overdraft facility from a banking perspective. Which, let's say for a grain farmer, for example, you have one harvest per season. Normally in August, they pay back their production credit or their overdraft facility, and then we restart the process for the next production year. So as I've said, benchmarking is becoming more important, and this is an extract from the Agric report that we compile from that. You'll see you have in the first column, you have your client, and we get all that information, and we benchmark him with peer clients in the same district, in the same industry, but also in other districts or other areas, but within the same industry, to see how they compare. Is he up to standard with what's happening in the industry? Interesting ones is your debt per cow in milk. We have certain benchmarks for that. Your EBITDA per cow as well. So those numbers is becoming important for the financiers as well. So credit guidelines, intensive agriculture, and that's, as I've said, that's normally your poultry, dairy, feedlots, piggeries, is intensive agriculture. And where we see that where there's a failure in operations, that will most likely result in significant capital losses. Someone asked a question about new entrants into the market. If we look at the dairy operation, to get a new entrant into that market at a sustainable level is quite a capital intensive exercise. A milking parlor, a dairy herd is expensive. So if something goes wrong, there will be significant losses, and that's important to note. And I think that's why those listed industries, you won't see necessarily a lot of new entrants into those markets very soon. So in terms of the credit guidelines, I've alluded to that. Your debt ratios. If you look at extensive, 60%, intensive, we can go a bit more. But if you look at livestock that extensive livestock, we normally look at 35% debt ratio, and that's typically your Karoo farmer, your sheep farmers in the Karoo and so on. Gearing, you can see the numbers there. The leverage as well, your EBITDA, your net debt in relation to EBITDA, preferably less than 4 times, and intensive 3.5. For livestock, the extensive livestock, that will vary. That there's a lot of factors that will have an impact on that. And then your interest cover, we prefer to have at least 2 times interest cover. That's where your profit should be, or your cash profit should be at least enough to cover your interest payments 2 times. So where do you, as a vet student or a nutritionist or industry role player, fit in? It all boils down to your production. And your production is a function of your herd status, your cow management, udder health, and a couple of others, and obviously reproduction. So in terms of diagnostic benchmarks, and that's your technical benchmarks, which you have more knowledge of, that will have an effect on your production side. So normally, you will have on-farm expert groups, and specifically in the dairy industry, they make use of that a lot, where the dairy farmer has a nutritionist, he has a agri-economist, he has a vet, he has a labor expert, and they meet once a month to discuss everything that's going on in the farm. Very important, and I think a very useful exercise to do for every dairy farmer that there is. Then, in certain areas, a couple of dairy farmers, let's say 10 dairy farmers, will employ a vet, or they will employ a nutritionist, and you will only work for that group of farmers. And that's more in your high density dairy areas, KZN and the Eastern Cape, for example, the Garden Route, where that will happen. Obviously, you can go into consultancy through your own practice. And then, from time to time, financial institutions might request expert inputs when they receive a complex loan application. They will go to the vet or to the nutritionist and soundboard that loan application with them. And then some other issues, you might become involved in lawsuits where there's certain deviations and there was a big loss. Let's say 300 cows died. You might become involved, but before you can do that, you have to build up some expertise as well. But yeah, not always nice to go and give evidence in court. I think the important thing is to make yourself relevant as an industry player. Darwin said it's not the strongest of the species that survives, nor the most intelligent. It's the one that's most adaptable to change. And as I said in the beginning, change is inevitable. We can't get away from that. By a show of hands, a quick poll. How many people still have Nokia phones? I thought so. I don't see any hand. In 2018, sorry, 2000. Yeah, in the year 2000, this was the most valuable brands in terms of brand value across the world. Coke was number 1, Microsoft 2, and you will find Nokia up at number 5. But things changed, as you might all be aware, because you probably sit with a Samsung or an Apple phone next to you. But yeah, as I've said, things change over time, and that's not long ago. It's 21 years ago. You will see where it ends in 2018. That's 3 years ago. You can keep your eye on Nokia. For example, you can keep your eye on Microsoft and some of the others. You will see a couple of interesting and well-known brands, Toyota. There you will find Google coming up on the board. Has a massive growth. 2010, that's the year we hosted the World Cup. Apple came up, and you'll find that Nokia actually dropped off. There's Samsung coming up. A new kid on the block is Amazon. And look at the exponential growth that Amazon have achieved over the last couple of years. There's Facebook. And I'm sure if we put on Twitter and Instagram, they will also be there. So this is where we end in 2018. Apple number 1, Google 2, Amazon 3, and Microsoft 4th. A lot of well-known ones still there, Toyota, BMW, and so on. But the top 4 is platform business. It's companies in the IT and those industries. So what makes it significant? Which one would you like to be? Would you like to be a Nokia, which was the best phone? Would you like to be, would you like to be the Apple, which is now number 1? Or do you want to be Microsoft? If I had a choice, I would prefer to be Microsoft. And why Microsoft, which is not number 1? Microsoft has been there on the board since the beginning. They stayed relevant in terms of the products and the services that they deliver. They stay relevant in terms of technology, whereas Nokia thought they were invincible, but then came Apple and Samsung and they've kicked them off. The question is, if Apple is not going to be adapt, or if they don't adapt to change, the same might happen to them as well. So adaptation to change is important. And then be informed. Know what your client wants. And I think that's relevant for everybody in business, whether you're a vet or a nutritionist or a farmer or an economist or whoever. You must know what your client wants, and your client will not necessarily be the consumer. It might be a feedlot. It might be a farmer when you are a vet, but you must know what he wants, and you must deliver on that to stay relevant. In the end, please don't lose your focus, because when you lose focus, and it will have unintended consequences, which is also not very pleasing. Thank you very much, Elena and participants. I really enjoyed it. And if there's any questions, I'll be happy to bat it now.
Thank you, Dawie. We've got some questions for you. One guest saying, good morning. You've mentioned built facility as having depreciating value. Should not the built facility have appreciating value?
Yes, it will have, but in terms of your financial bookkeeping, there will be a depreciation on that facility, because it will have, your milking parlor, technology change, and things. You will need to replace it at some stage in any case. So there will be a depreciating aspect as well.
Okay. Dawie, can you just switch on your video? Yeah. I think it's easier for the people to talk then.
Yeah, apologies.
Okay, thank you. Another question from Reese Terblanche is it beneficial to have an asset depreciated at an accelerated rate? I'm wondering if it would be a benefit or a disadvantage.
No, it will have, it depends. You can't have it, for example, if you look at a building, um, tax regulations will not allow you to have it depreciating at the accelerated pace, while with vehicles and consumable, technology and so on, they allow you to have accelerated method. So in the end, it comes down to a zero sum. So it won't have much of a difference. But you have to look at the tax regulations as well.
Okay, then the last question I've got here is with regards to the net book value. Does it affect when you sell or replace an asset, for example, a vehicle?
No, it doesn't. When you sell or replace a vehicle, you look at a market value. The net book value is purely for accounting purposes.
Okay. Is there anyone else who would like to ask a question? Then you can, Dr. van der Leek. He has a question, you can unmute and ask.
Dawie, good morning. You already know the question I'm going to ask, don't you?
Most probably, yes.
No, just for our students' sake and maybe others, what does the bank think about the value of a cow?
Yeah.
How do they see it?
Yeah. So the value of a cow is quite interesting. We do have a product where we can finance a cow or finance a farmer and take a GNB, which is a general notarial bond over a cow. That's not a preferred instrument that we use to finance because we found that the cows that or the cattle that the bank has a GNB over is most probably the ones that got stolen first or died first or something like that. But it's still a product that's available. So we look at cows in terms of the production value of that cow. Obviously, there's a tax value, which I think still for a cow it is still 25 Rand. And I've heard that SARS is now looking to review those tax values for livestock. But in terms of a banking and a financial institution, we look at a production value of a cow. And when, if we look, for example, at dairy cows, when there's difficulty, we'll compare production value against your slaughter value as well. I hope that answers your questions, Dr. Martin.
Perfect, thank you.
Any other question? Okay, thank you, Dawie. We've got no questions. We only have a thank you for you from Luke Bauer.